Hi everybody, it's Thomas with the third quarter market summary. All my contact info is on the screen there, and I'm going to go through this pretty quickly. If you want to pause, you can pause to look at any slide in detail. Let's take a look at the chart of the market so far this year. So on the left is probably the fourth quarter of 2019, and then this dotted line is the beginning of the year, and it goes all the way to the present, today's date. We of course had the big decline in the first quarter, snapback rally, the V-shaped recovery that endured all the way through the third quarter. So we had positive returns this quarter, and in the fourth quarter we're still up very close to the market highs that were set back in the third quarter. So this is the summary of asset classes: the US, developed, foreign, emerging markets, real estate, and bonds, and everything was up. US was up big. Just wanted to highlight that a 9% quarterly return is much greater than the average, and we had the best quarter, set a record in the second quarter on that snapback rally, which surprised most investors. Those of us that just stuck to our guns and kept our allocation did capture the returns, which was great. And of course, the first quarter barely missed setting a record, but the record is still held by the 2008 fourth quarter. So if we look at a longer term, we looked at quarterly results there. Let's look at 1 year, 5 year, and 10 year. And these numbers are all annualized for multiple years, 5 and 10 years. These numbers are per year. And US stocks are, for the 1 year period, are up huge. International and emerging markets trailing by a great amount. For the 1 year, 12-month period, real estate is down. And I've highlighted the fact that we own real estate in some of our mutual funds, but we have a separate real estate investment that is a loan portfolio, and it's a stable value income fund. It returns about 7% per year, and accounts that are appropriate to have this in it and qualified to have this in it, it's up 5%. So SAFE has worked so far this year. Not going to always be the best returning thing, because real estate does have some, averages 5.5% over time. It has some big spikes and big declines. So you can see US has been outperforming for quite a while. Then this is the news on the bottom, and this is a third quarter time period. So it just shows the price of the S&P 500, or actually the all country index, with the news that was associated. And we're all well aware that the news has been coming fast and furious. This is similar with news items on the bottom, and this inserted area, it's a long-term chart here, and the shaded area is this big. And we have the fourth quarter again of 2019, which was equities were up huge, big decline, and the rally since the big decline due to COVID. So if we look at US stocks in general, still being led by what is called the FANG stocks, which is Facebook, Apple, Netflix, Google, and Microsoft have a nickname called FANG. And they're 22% of the S&P 500, and they continue to get pushed up to higher and higher prices by investors. And small cap value, which is the thing that we overweight, not doing great. But it's not like we don't own, our S&P funds and our US funds are heavily weighted in those stocks, so we own them, and so we're that's why our accounts are going up. We're just not overweighted in those stocks. And international developed is a little different, because small did better than large in that area. And if these things were predictable, we'd jump from one to another, but they're not. So we overweight the things that have consistent better performance over time. And then same type of graph in the emerging market sector, where growth and large did better than value. Now we're looking at country returns, and in the developed world on the left, almost every country except for 3 countries were up, and some of them were up very, very big in the third quarter as everybody's bouncing back from the COVID decline. And then in the emerging markets, which tend to be a lot more volatile, about half are still in recovery mode, and half were down this year, or down for this quarter. And here's commodities. We're similar to stocks. We own commodities in our diversified mutual funds, and we do periodically overweight gold. We don't overweight gold at the moment because it's priced very high in the upper level of its range, according to me. And there's a level that I will accumulate about 2% position for appropriate accounts. But as usual, very volatile in commodities. I've highlighted the 10-year returns of commodities because about 10 years ago, there was the end of a very strong speculative period when there was conventional wisdom that many different commodities would be in short supply due to China's growth. It turned out not to be the case, and this is often the case with trends. A lot of people jump onto a trend that is exhausted sometimes by the end and try to guess that that trend is going to continue. And in this case, it didn't continue, and there's been poor returns over time for this category. So this is just a chart, an explanation of why we overweight small cap value, even though we have numerous underperformance years over time. If you are patient, you've still been able to capture what's called a value premium. And if we knew when the bars were going to get above the line versus when they were going to below the line, we would be jumping in and out. Lots of people try that. The returns are bad, so we don't do that. And that is really it. If you have any questions, you're welcome to call me anytime. And I look forward to following up with everybody shortly. I hope you're well and stay safe. Talk to you soon.